Welcome to This Explainer. Today we're unpacking a massive, rapidly escalating financial reality behind the artificial intelligence boom. We are tracking a major macroeconomic shift, moving away from the staggering corporate spending that dominates the financial headlines and looking directly at the hidden risks sitting right there in your retirement account. It's this profound disconnect between Silicon Valley's sky-high expectations and Wall Street's actual ground-level fundamentals. And the core takeaway for us today? You are already heavily invested in this gamble, whether you actively chose to make the bet or not. So, let's get into it.
Okay, look at this shocking number. Back in January 2025, one single announcement from a Chinese company that practically nobody had ever heard of erased $600 billion from Nvidia's value, and that happened in a single afternoon. The developers who built that $600 billion, they never saw it coming, mostly because the market was just too busy counting the money. But that single moment served as a massive stress test for the whole industry. It really exposed just how fragile these record-breaking tech valuations might actually be.
Section 1. The $600 billion warning sign.
So Nvidia's valuation had actually crossed the $5 trillion mark because the market simply assumed their cutting-edge, wildly expensive chips were the only possible gateway to building world-class AI. But then, Deepseek shattered that assumption entirely. By building a top-tier model using older, significantly cheaper hardware, Deepseek proved you don't necessarily need trillions of dollars in state-of-the-art infrastructure to compete. This breakthrough instantly cracked the entire foundational premise supporting Nvidia's massive valuation. Almost overnight, the narrative flipped from absolute undisputed dominance to sudden vulnerability.
Section 2. Spending beyond historic precedent.
Right now, the broader AI industry is taking on debt at a scale we've literally never seen before. Take OpenAI as a benchmark. They generated roughly $13 billion in revenue in 2025, which, sounds fantastic on the surface. But they have simultaneously committed a staggering $1.4 trillion to future infrastructure over the next 8 years. Think about that for a second. That essentially translates to spending $100 for every single dollar they earn. It's a growth model funded almost entirely by future debt, which is a complete inversion of how traditional tech growth strategies actually work. And here's where this dynamic highlights a really severe valuation problem. OpenAI's operating losses were $8 billion in 2025. But those losses are expected to more than double to $17 billion in 2026, and then double again to $35 billion in 2027. So despite bleeding capital at an accelerating rate, where their losses are growing way faster than their revenue, private investors still value the company at 57 times its annual revenue. The whole thing is propped up on the assumption that future profits are eventually going to magically catch up to this massive current deficit.
To really put this market exuberance into perspective, let's look at Palantir. Investors are currently paying $98 today for every $1 Palantir is expected to earn. Now, for a mature, healthy company, traditional financial models usually expect a multiple of about 15 to 20 times earnings. At a 98x multiple, that company would literally need to achieve near-perfect, uninterrupted growth for an entire decade just to justify the premium price investors are paying for it right now.
Section 3. Echoes of past financial crashes.
If this staggering scale of speculative spending feels a little familiar to you, well, it's because financial history is repeating itself. The 2000 dot-com crash didn't happen because the internet was fake. It happened because investors operated on the wildly flawed assumption that any company touching the internet was worth infinite money. It's just like how the 2008 crisis was built on the dangerous idea that national housing prices simply never fall. Today, major players are borrowing billions to chase this infrastructure boom, and we're seeing companies like Oracle facing massive stock drops because of it, all because the AI market is resting on those exact same untested assumptions of infinite, frictionless growth.
There's a single ratio that perfectly captures the systemic risk building up in the market right now. Across the entire tech industry since 2022, we're seeing a severe 10-to-1 gap. Over $1 trillion has been heavily invested into AI infrastructure, weighed against less than $100 billion in actual, estimated revenue returned so far. The critical flashing red warning sign for the market is that this capital investment is still accelerating, while the actual revenue returns are lagging further and further behind.
Section 4. Your hidden AI market bet.
Now, you might be thinking, hey, this only impacts Silicon Valley venture capitalists or high-frequency day traders, right? Actually, no. Whether you meant to or not, if you have a 401k, a pension, or if your employer matches your contributions into a standard index fund, you are forced into this bet.
As we speak, a massive 30% of the S&P 500's entire value is completely propped up by just 7 tech giants, and every single one of them is making the exact same concentrated technological gamble.
Let's bring this down to a personal level. The average American 401k balance sits at roughly $134,000. Because of that heavy market concentration we just talked about $40,000 of that average account is heavily locked into this specific AI sector. If the NASDAQ, which by the way is currently trading at valuation multiples we haven't seen since 1999, takes a significant hit, nearly a third of your retirement savings could face a massive 15-year recovery cycle. That directly mirrors the fate of everyday folks who retired right at the peak of the dot-com bubble.
Section 5. Warning signs and next steps.
These financial cracks, they aren't just grim predictions for some distant future. They are actively playing out globally right now. We already know the historical impact of the 2000 and 2008 crashes, but fast forward to June 23, 2026. On that specific day, the South Korean stock market literally had to suspend trading to prevent a total collapse. Major AI hardware suppliers, heavyweights like Samsung and SK Hynix, lost 12% of their value in a single morning, and they dragged the global NASDAQ index down right along with them.
And this volatility isn't just retail panic or internet speculation. The Bank for International Settlements, an institution that operates essentially as the central bank for central banks, has publicly issued a really severe warning. Looking purely at the data, they stated plainly that if this AI bubble bursts, it possesses the structural weight to trigger a systemic global financial crisis. It's an incredibly rare, explicit alert from an institution that traditionally deals purely in quiet, behind-the-scenes macroeconomic stability. It's also absolutely vital to track what the smart money is doing while everyday retail investors keep buying into the hype. Tracking recent insider trading reveals a really clear, distinct pattern. Executives at companies like Nvidia, Palantir, Micron, and Broadcom, the people with direct, intimate knowledge of their own financials, have quietly and consistently sold close to $13 billion of their own stock since mid-2023. Historically, when insiders sell heavily while the public keeps buying, it serves as a highly reliable warning sign.
Now, let me be absolutely clear here. The underlying technology is not a fad. Artificial intelligence is absolutely real, and the long-term productivity gains and economic transformations it promises are totally legitimate. However, just like the early internet, paying astronomical 1999 level prices today does not guarantee a company is going to survive the inevitable market correction, especially when the technology takes much longer to generate revenue than the current sky-high valuations demand.
Historically, speculative bubbles are built by massive institutional wealth, but the resulting bill, well, that's often paid by everyday index fund holders like us. Back in 2008, the investors who managed to preserve their wealth were the ones who analyzed the underlying data, recognized those flawed assumptions early, and repositioned away from over-leveraged assets. As we wrap up this explainer, the data presents a clear historical parallel, which leaves us with one vital question to consider. How is your portfolio positioned to weather the storm if this modern tech bubble finally pops?